The Great Depression was an economic disaster of unprecedented proportions. A quarter of the US's workforce was unemployed. GDP fell by 15%, a stark contrast to the 1% drop in 2008. But what exactly happened to cause this? Inflation was rampant in the years of World War I. The world governments borrowed huge sums to finance the war in Europe. Following the war, the Roaring Twenties were a time of lavish consumerism. Middle-class Americans enjoyed new technology such as the radio and personal cars. The ultra-wealthy took advantage of the cheap debt banks were offering and lived well outside of their means. The fun ended when the stock market crashed in 1929. The market fell 11% and some 16 million shares were traded. It was the largest sell-off in US history. Following the crash, the market continued to fall over the course of 3 years, sinking 89%. It took 25 years for the market to reach the peak of 1929 again in 1954. Fortunes were devastated, and many people lost everything. In the fall of 1930, fear overtook the American population in an event known as the Run on Banks. After a series of bank closures in Tennessee and Kentucky, people swarmed their local banks around the country and demanded their money withdrawn. At the time, banks were small individual institutions. If they didn't have enough money to accept withdrawals, they would go under. This led to a huge wave of bank failures. One of the greatest American economists, Milton Friedman, pointed out that this series of withdrawals forced banks to liquidate their loans, directly leading to the lockup of the entire credit system. Imagine a bank. Everyone deposits their money and, as a result, the bank loans the money out as mortgages and business loans. Since the bank earns interest on these loans, let's say they give out 80% of their cash. One day, the town residents spread a rumor that the bank is going under and demand their money be withdrawn. Since it's illegal to deny withdrawals, the bank is forced to liquidate their loans and give the money back to the townfolk. Housing prices crash since people can't get a mortgage, and businesses fail since they can't afford goods. Effectively, a lockup of the credit system. This economic disaster went on for years until a series of government programs, a part of FDR's New Deal, saved America. Today, we are seeing unprecedented levels of leverage and inflationary government spending. Consumer debt is over $16 trillion, as average Americans live well outside of their means. The average college graduate has $30,000 in student debt. World governments are escalating conflicts with US interests, and as a result, military spending is increasing. Since 2020, the Federal Reserve has printed almost 80% of all US dollars that exist. Corporate debt reaches over $10 trillion. Liquidity in the credit markets is drying up, requiring larger and larger injections by the Federal Reserve. The bubble is bigger than ever before. So, how do we profit in the next Great Depression? There are 4 classes of investments we are going to discuss: metals, bonds, real estate, and stocks. We will compare their performance over 25 years from the crash of 1929 to 1954, when the markets recovered with a portfolio of $100,000. Gold is and always has been a sound investment since the invention of currency. At the beginning of the Great Depression, the dollar was backed by physical gold. People were exchanging their money for gold in such volumes the US Treasury worried they would run out, FDR's solution was a ban on gold hoarding. Despite this, if you were to invest gold, you would have netted a 70% return. Investing in precious metals comes with high fees for physical gold. Other avenues of investment are through gold ETFs and mining companies, although they are valued based on the performance of gold, and they are not a store of value. Bonds. During the Great Depression, bonds performed well given the circumstances. AAA bonds yielded great returns for investors. Consistent investment in AAA bonds in our simulated portfolio would have yielded 129% return. Stocks. Although the market performed horribly following the crash of 1929, we will assume we bought following Black Tuesday. Given no one can predict the bottom of a depression, we will illustrate that this fact doesn't matter. In our simulation, we invested our portfolio in the S&P 500 and let it sit, netting our portfolio over a 400% return. And finally, real estate. During the Depression, housing values fell 35% and construction came to a near stop. After a series of government interventions, building continued and brought the market back. Given the average price of homes year to year and averaging the returns, we would have netted 144% in our portfolio. This is purely based on the value of the property and not including any rent or leasing opportunities. Comparing these strategies, we clearly see that stocks are the winner. However, there are benefits and drawbacks to all investment strategies. The best thing you can do is diversify. Using the lessons learned in the Great Depression, we can use opportunities of economic distress to grow our portfolios.